We've been privileged to get to spend so many mornings with you, Mohamed. The market does look like it's moving higher on the back of science. You've talked about how this is going to be solved by science ultimately. How do you think the market and investors should think about this kind of news?
So first, it's very good news. Remember, there's 3 steps to the health solution. One is treating the illness better. The second is containing the spread of the virus. And the third is immunity. And on the first one, we have better news. That's really good news. It's also good that we have a roadmap to how we're going to reopen the economy. And we need it, Andrew, after this week's data, retail sales, industrial production, jobless claims, housing. They were all pretty scary. So it's a good thing that we have it going forward. We have a roadmap. We have progress on a critical health issue. And one just has to consolidate these gains to maintain what you're seeing in the marketplace today.
But Mohamed, you know, over the last week or two, you've been a bit skeptical, I think, of the rise in the stock market. You've questioned whether we're going to see some negative downdrafts in a meaningful way. The question is, can you bet against 2 things? The government and all of this government support that's being thrown at this, and science, because if you're not in the market effectively when we finally do get announcements about things like that, you may miss that. That's the optimistic view.
Yeah, that's the wrong question. It's how you bet. I have been saying bet up in quality. And if you look over the last few weeks, it is the companies with the better balance sheet. It is the companies that live mostly in virtual space that have done better. The NASDAQ has outperformed the S&P and has certainly outperformed emerging markets. So the up in quality trade has worked so far. So the question is, how do you stay engaged in the market, not whether you should stay engaged in the markets. The reason why I pause is because of the level of valuations. The S&P is about 20, the PE ratio is about 20 last year's earnings. Now, a few companies in tech, in healthcare, some very essential consumer staples are going to have similar or better earnings, but most will not. Not this year, not next year. So it's a valuation issue that sort of holds me back. But the relative value trade, the up in quality trade, I like it all day long.
Okay. All right. We like your quality. You fall back on that a lot, Mohamed. But so regrets, I've had a few. I think it's a song. I mean, 3 weeks ago, really, we're going to grind lower. We're up 30% since then. You don't wish, maybe you just said, yeah, buy quality, don't buy quality, buy anything, up 30%. No regrets whatsoever of staying a little bit bearish too long? None whatsoever?
No, of course there's regrets. And I could have never imagined, and it is controversial, Joe, I could have never imagined the Fed going in and buying high-yield bonds. And there's a pushback against, was that a good idea to get exposed to more credit risk, more default risk? Did I predict that? No, I did not. And I don't think they should have done it. But I certainly didn't predict it. And had I predicted it, I would have been more positive on buying the market as a whole, because the market has immediately embraced that the next step in the capital structure, and it's not a big one, once you cross into investment grade and to high yield, the next step into equities doesn't look that big, is the Fed buying equities. And that now is in the marketplace.
Let me ask you separately, Mohamed, about the price of oil, because we're now in the $18 range here on a barrel. In a normal world, the equity market, everybody, that would be the conversation, and there would be panic in the streets, you would normally imagine. Can you explain the disconnect?
Yeah, there's 2 very interesting dynamics going on. One is that demand is falling, and the China number was particularly influential because China is a high energy intensity country. So when GDP contracts by 6.8%, that's meaningful for energy. But the second one is look at the difference between WTI and Brent. It is WTI that's getting hit very hard. And that's about storage, Andrew. It has a particular, there's nowhere for the oil to go. So the demand gets hit also on the inventory side. So it is a big deal. I think the marketplace is looking through this. A few weeks ago, that would have disrupted the market, but the market is seeing a few things that it's embracing. some of which I also embrace. We are seeing advances in medical issues as so many brains are allocated to that. We are seeing a roadmap for reopening. I embrace these two things, but they're also seeing a very strong Fed put. That's the one I don't embrace.